Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. And our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Last week on the show, we introduced the 4 pillars of successful options trading and introduced ORATS University. Today, we'll review the last few trades we made on the show, and then dive into double calendar spreads. Calendar spreads have been a highly requested topic on the show and are a popular strategy around earnings season. We can't wait to show you the double calendar spread in the new option scanner. But first, let's review the trades we made on the show so far. Matt, if you're ready, do you want to share your screen and go over the trades?
Yes, sir. All right, so I'd like to start off on just looking at SPY, looking at the market. What's interesting right now is, so these are, this is the stock prices over here. This is the implied volatility in blue and the historical volatility in magenta. So that's a little bit below 10 right now. We have our new chat with us, so you could, if you're on the dashboard, you could chat with us. Volatility is on the rise. There's a lot going on this week with the FOMC. You could see these, today, tomorrow, not as busy, but then the next 3 days, volatility is pretty jacked up for the FOMC. So I think that's a good thing to keep in mind when you're looking at what's coming up in the week, and we're making some trading decisions here. So as you mentioned, Tyler, we have a couple of trades open. We put on a long put diagonal last week, and we put it on for $1.78. It's currently at $1.97. That's good for us. We're long the longer term, farther out of the money put, so 185. But it's so many days farther that it's much more expensive. So that's 678. The short puts 483. So both of them have come down, but the 90 as that we're short came down more, so we're up on that trade. We have an alert. The alert will tell us when we're, and I'll pull it up and just show you how the alerts work. It'll tell us in the backtest, the optimized exit strategy for this trade is getting out with a 50% profit or a 75% loss. And then this is interesting. The ask minus bid over the stock price has to be less than 0.1% or 20 cents wide. Otherwise, you might bad alerts. There was actually this morning when I looked at it, the markets were really wide, and it had a 50% profit, but it wasn't really tradable because the markets were so wide. So that's why we put these X alerts in. Eventually, we'll be auto trading on these X alerts, but you want to, when you do X alerts, you want to have some concept of the market width. Does that make sense, Tyler?
It does. Yeah, the market width is very important. And you talk about the auto trading. We're working on some really neat features with the execution algos and stuff like that to really improve your execution for entering and exiting, which is very exciting.
Yeah. So here's the payoff picture. We have some room between about 180 and 213. So like I said, there's a lot going on, but hopefully we stay between those two and we get some beneficial movement in the trade. There is some vega to it, but it's not a huge amount of vega. The cool thing is when it goes down, there's more vega that's to our benefit. So this kind of where we're losing in this trade will be less loss because if all goes up, you can see this purple line. We're not going to be as bad as there. So we're staying in this long put diagonal. We found that long put diagonal in the trade ideas last week. And then we have this The wheel strategy still continuing to chug along. We got 5 days left. We're short. We're doing really well on this trade. Doing well. We're doing pretty well on all the trades that we've done so far. I think there was one small loser, maybe two. I have to go back through the videos, but we sold it for $5.90. It's only worth 18 cents. I'm going to buy this in, Tyler, and then wait till this week's over and start it over again. Hopefully that's not cheating, but hopefully we get that makes sense. So our paper trading account. All right, so we failed on that one. So today, Tyler, what do we want to talk about?
The double calendars. So we've gotten some, we've been paying attention to your guys' comments, and we've gotten a few on calendar spreads, which, ORATs, we do a lot with calendar spreads, especially around earnings. It's a very important time for calendars. People love to trade them. So today we're going to look at kind of a custom strategy, which is a double calendar. And double calendars are, very useful for just taking advantage of the volatility crush, which is what happens. Volatility rises when you go into earnings, and then right after earnings, it falls. So we want to look for something where we can sort of play around with the front month and the back month volatility, use, a bunch of our indicators that we have at ORATs, namely the contango indicator. And then we're going to scan for some stocks and then plug those into the option scanner, where we have a custom double calendar spread that we're excited to show you.
All right, good explanation. Thanks, Tyler. So the first thing we do is try to identify stocks. The stocks that we identify here will then feed into the option scanner. The option scanner will show us what we think are the best edge. So we have a forecast of where we think the theoretical should be. And so we want to find something with the most theoretical edge based on good stocks at the beginning. So, as Tyler said, we're going to be looking for stocks, and I have a pretty high stock price. And then, I want implied volatility to be within a certain, now this is X earnings. So, I mean, you might see some earnings, in the 70s even, but we take that earnings effect out. That's probably another webinar that we should do about the X earnings and earnings effects, Tyler. So let's put that on. Let's make a note there. Now, contango generally, if this is IV and this is time, so the shorter months usually this is what we see for the shorter month implied volatilities are lower than the farther out months. Of course, when we get earnings, we get much higher front months, and then lower back months near normal. And so what happens after earnings is the vol crush, as Tyler talked about. These will fall all the way down. And so we want to take advantage of that by selling these and buying these out months that are more fairly priced. And so the way we do that is we look for negative contango. Contango is a state where the lower months are the front months, higher months are the back months. It's really negative contango is really called backwardation, but we measure it and just call it contango. So that's why it's negative. Weeks until next earnings, max 1, so 0 or 1. Asset type, these are all stocks, have some market cap, and an average option volume of 2,000. So that's how we get this list below. We have a nice list.
Matt, I just want to clarify the contango indicator, exactly what it measures. So it measures the slope of the at the money implied volatility for the short-term expirations. Do you know exactly?
Yeah, 45 days is the tangent at the 45 days. So, it goes kind of between 90 and 0, and then it just draws the tangent slope there, and that's the contango slope, really.
Got it. Okay.
All right, so here we have a nice list. And we could, if you mouse over, you could see what the what the graph of these contangos have been. EA's, Electronic Arts, Take-Two, CMG. So all these are going to feed into, now when we go over to the option scanner, they're going to feed into over there. So here's Take-Two, here's EA, and the rest of them. So I have it where, this is my list of stock scans, and then I have put a custom strategy together, which is one of our new features for the option scanner. So I want, to buy about a 30-day and sell about an 8-day. And then the strikes are, about 40 vol, between 20 and 40. And then, and so that should come up with some interesting stocks there. So let's take a look. So UPS, custom 2 is just the name, that's just a custom scan that we have. So, this has been scanning. So it looks like UPS and Starbucks and Qualcomm, are the highest ranking when we set these ranks. Now I could, move. I don't like the distribution as much for earnings because we don't count that as in the distribution. So I take that out. So really, we're just going to look at the forecast, a little bit on the smooth. As a matter of fact, I'm going to take out some of the smooth edge. I like taking out, we could do -3 to 3. So I don't want to have too much edge because, it sounds like, hey, why wouldn't you want edge? Well, you're not, the market maker is smart. You're not going to get filled on a particular trade if you have too much edge. So 3%, that's quite a bit still. So again, it's pulling in these types of options. I like the risk reward. I could maybe move those down a little bit. And then again, smoothing is there a little bit in the forecast. So I like how these are sorted. So that, if you're wondering how we sort all these, that's how. Probability of profit, reward to risk, max loss, deltas, a lot of this, and that is in there. The open interest is at each one of the legs. We could see how wide the market is. And you could set like a maximum. So these are all over 1%. Let's see if there are any really wide ones. 1.4, but not too bad for a four-leg spread that we have. So let's check this out. Let's look at the detail. Try to find a good trade to get into.
So I want to point out real quick, Matt, the max loss number that you briefly sort of scanned over it. It's hard to trust that one for calendars if you're looking at a payoff diagram, because it's hard to forecast where that is going to be at expiration, because we're it's a play on volatility, so we're really relying on volatility to drop, and that's going to change the payoff at expiration. And so that's why you see that payoff diagram have a very wide range of green. That is less likely to happen as you go into expiration.
Yeah, well put. Yeah, we're not doing anything to try to predict what the stock will fall to, but we know volatility is going to fall quite a bit. I have it going down just kind of 28% randomly here, and moving it out a couple of days, and still see a nice, a nice wide payoff picture is what we want to see for this particular one. Yeah, so the trade is buying March, selling this Friday. Still a lot of premium in this. That's what we like to see. And then these, the 165s doesn't have that much extra premium in it. So this looks like a pretty good trade to me. Todd.
What's interesting here, Matt, if you look at the profit attribution, you're saving 74 cents just from yesterday because of the Vega move.
Right. Yeah. So Vega, yeah. So this is a long Vega trade. So Vega must come down. Like I said, look at this difference. So remember when we were searching for stocks around 30, this is on the high side, but look at these IVs in the front for UPS. So they're really thinking it's going to move a lot, and we'll sell it to them.
All right.
So I like this trade. It's worth about $2 on our smoothing. So I think we're gonna have to pay more than that. Just I try to using the paper trading, you could force a trade, or you could go into our kind of random fills, or you could pay the offer. Usually you don't have to pay the offer, especially on a 4-leg like this. So I think if we gave them 2.05, 4 cents of edge, I think we could force that and be relatively confident of that filling. So send that in. That's gonna be our trade for this week, Tyler.
Perfect.
Pretty exciting.
Before you send it in, let's go over the exit alerts. Are there any that you look for in calendars, or are we looking to exit when the volatility hits a certain amount or a number of days?
I'm just gonna say alert me one day after earnings.
Okay.
So I mean, I'm just gonna that's when I look at it.
Yeah, sounds good.
Thanks for reminding me though.
Yeah.
So yeah, that will go in if this fills, which it will. All right, so that filled, and you can see the filled orders here, and then made it into our positions here, and you can see the alert that we have one day after earnings. So we're down 5 cents in it on the marks, but yeah, I feel good about this trade, Tyler.
Yeah, me too. The double calendar is interesting. So can you go over why you personally like the double calendar more than just a regular calendar, and sort of explain to the viewers the difference between the two?
Yeah, so double calendar, it's interesting when you're doing calendars, because you could do a calendar that's out of the money, and why don't we just pull up a calendar here in 1 week. So if you do a calendar that's out of the money, you want the stock to go towards those strikes, and if it's at the money, you want it to stay where it is. So it's interesting in earnings, you could do a calendar and you could be wanting it to move quite a bit. You want it to move to your strikes in the calendar. Mm-hmm. So in this particular example, let's see if we can find any. I'll just explain it. I think it's easier to explain with this visual. So in this calendar, we want it to stay within a certain range here. Ideally it closes near one of these peaks in the tent, or in between those. Even outside it a little bit, we're going to do okay. So the double calendar, if it were close, if you just did a calendar right at the money, then you wouldn't have all this room. So why do I like the calendars? I like to find opportunities, from volatility. Sometimes the earnings, it's a little bit of a crapshoot. Is it going to move or is it not going to move? But this one, I feel pretty good about, like, the contango search. So if we're just wanting to isolate the contango, the double calendar is a really good way to do that. Does that make sense, Tyler?
Yeah, that's a very good point. You're isolating the contango and relying less on, almost like a straddle trade, right? I mean, I see the calendar payoff is very similar to a long straddle, where you're just, or a short straddle, I should say, but where you're sort of pinpointing the move. You don't want it to move outside that range at all. And with the double calendar, you're sort of saying it can move a lot, and we're still going to make money either way.
Right. Right. So, yeah, definitely. The important thing is when you have a thesis, our thesis is the contango is way too elevated or way too negative in these stocks. You want to set up a strategy that can benefit if you're right. So the double calendar, I think benefits the most. If when and if we're correct on this.
Right. Yeah, that's a great overview.
Yeah, and you could see it here. Like, you could see the extreme levels here versus kind of where volatility usually hangs out. we expect to lose some money in ours, but we expect the other ones that were long to make more money than we're going to lose in these.
I like this visual because you can see sort of the front month where we're selling those options with the higher volatility, and then buying the ones further out with the lower volatility, and you can just see the time graph, and it's interesting to see. Obviously, the ones that you're selling, you're going to get more premium for them because it has higher volatility, and the ones you're buying, they're cheaper because it's lower vol.
Right, and you'll notice it doesn't have to be in the same month. So we have a double calendar, but they do share the same strikes. That helps on your risk quite a bit, but it doesn't have to be this. Especially the long leg doesn't have to be in the same month. We're just looking for the best valuations from a forecast perspective. And then we could check out the earnings in UPS. So what we're looking at mainly here is, this is the implied move in the stock at earnings, and then the dark dots are where it actually went. So if you owned a straddle, this would be your profitable one. This would be your profitable one. So they've had a few profitable ones, but we're hoping that it does stay within this range here. Like we said before, we could go out a little bit from there. Really hope is that the fall comes in the front months more than it goes down in the back months.
Great. Is there anything you want to look at else today in the market intelligence, maybe?
I've been having a lot of fun. Yeah, looking at the market intelligence. I think this is a good thing to look at. So market intelligence, we see the largest trades out there right now. ZH has had some large trades. We see the top intraday movers. Subgroup is down 51%. And then, unusual volume, ZH. And then when we make it bold, like SoFi, those are stocks that trade with a little bit more volume. And then here are the earnings. Like today's earnings was SoFi and dividends. So you could go click on these. So I like to click on SoFi and go check out what's going on there with SoFi. And I really like this new time to sale. So you could either get at it here or get at it here. And what the time and sales does, takes a little bit to load, but we're going and getting every trade, and we're kind of marking up if we think they were buying or selling based on where the market was at the time. And then we say things like, are they mostly long delta? Yes, they're mostly long delta. Are they buying or selling premium? They're neutral. Have they been profitable on the day? They've been profitable. Is it opening or closing? And it's usually difficult to tell, but there's a fair amount of opening volume. And how do we tell that? Well, we look and we compare the contracts with the open interest, and we can tell in this case if there's more contracts traded than open interest, then that's an open. And a lot of that is going to be opening. Most likely, the whole thing's opening. And then I like to look at dollar delta. So if you look over here, this is kind of cool to look at. So usually they're pretty right. Like, so here are some big, this green is buying deltas. So they bought deltas and there are a few sells, but it generally just went up. And then it came back down. There's a big sale or a lot of sales around here, kind of stayed there for a bit, and then starting to rally with some small trades going now. So I think it's really interesting to look at, and it's a good view of what's going on. And you could sort these by average dollar delta. You can see what time they went up. So this is that big sell that we see over here. And let's see, they're currently not profitable on that trade. You could see how much edge they had. Were they aggressive? Like, this was a real aggressive trade right here. This was that 939. So this is that big green triangle right here. So I think that's really neat to look at when you're looking at a stock. It's something that maybe people aren't used to, but there's so much information in here. But this is a really neat thing to look at.
It is, yeah. I always look at the graph there. Sometimes it's pretty uncanny how it lines up with the stock price.
Yeah, agreed. All right, well, that's exciting. We got a nice trade. We're doing well on our IWM. What is this, diagonal? And we got a nice UPS trade to go through earnings with. We'll probably get out at earnings, and so we'll be showing you, hopefully these got crushed and these maintain some of this value. And we got out of our wheel strategy. We'll start that up after FOMC. So looking pretty good, Tyler.
Yeah, we got a plan. When does UPS report earnings again? Is it in a few days?
Yeah, so UPS reports earnings, and you can see it right here. It's January 3rd. So tomorrow, it's actually tomorrow before they open.
Yeah, all right.
That's what that sun is for. So yeah, so we'll find out how we're going to be doing.
Cool. Yeah, so leave comments, guys. We look at them, and that's kind of what this show is about. We've seen a lot of interest in calendars, so we're always happy to hear what you guys want to see next. The dashboard is very robust. We can do a lot in there, so a lot of back testing, a lot of scanning, a lot of trading. But yeah, thanks, Matt, for demonstrating that double calendar. Unless you have anything else, we'll see you guys next week.
Yeah, I'm good. Thanks, Tyler.
Thanks, Matt.